Okay, hi class. Welcome to chapter 24, differential analysis and product pricing. In this chapter is a bit of a continuation of chapter 23. The primary difference that we're looking at here is different ways to analyze the information and from a cost perspective. And we're also looking at ways to price our products in order to get them ready for sale. So the first thing I want to talk about is differential analysis. This is a way for managers to make decisions involving the choice between two alternative courses of action. An example would be, should I produce product A or produce product B? That is an alternative strategy looking at two different options. Although the managerial decision-making process varies with both types of decisions, it normally involves the following steps. Step one is we identify the objective of the decision, which is normally to maximize revenue. I mean, that's the objective of pretty much every business, right? Step two, identify alternative courses of action. Step three, gather as much information as possible to perform a differential analysis. Step four, make a decision. And step five, review, analyze, and assess the results of the decision. So the primary basis of a differential analysis is looking at two different potential decisions by looking at these two different options and then making a decision. That's the basis of a differential analysis. It's basically, when you hear the word differential, think of the difference. So it's the difference between two different things. So here's an example. We assume this restaurant company is deciding whether to replace some of its customer seating tables with a salad bar. Bryant's differential analysis decision-making process is shown in the following slides. So step one, the first thing the restaurant has to do is identify the objective of the decision. In this case, if the restaurant wants to install a salad bar, the objective here is to increase its revenue, right? Through the sale of salads, probably through some type of like buffet style salad offering. We see restaurants do that quite frequently. Step two, identify alternative courses of action. So in this case, there's really two courses of action. One is to install the salad bar and replace the existing tables with that. And the other alternative is to just keep the existing structure in place and not install the salad bar, and by using the existing seating arrangement. Okay, so let's look at it by gathering some potential information here. So alternative one is we have our current seating arrangement. Our revenues would be $100,000. Our cost would be $60,000, leaving us with an income of $40,000. Of course, you get that by taking your revenue minus your costs or expenses to get your income. So that's alternative one, is to leave the tables as they are. Alternative two, by installing a salad bar, is we would see a potential increase in revenues of to $120,000. Of course, with additional stuff or additional supplies, we would expect our cost to increase to $65,000, and our potential income from that installing a salad bar in this example would be $55,000. So that's step three, is to gather your relevant information. So in looking at those two potentials, we want to conduct what we call a differential analysis. This is where we look at incremental data by analyzing differences between the revenues and costs in order to determine the different impacts on income from the two alternatives. The differential revenue is the amount of the difference. It's the difference in revenue, the increase or decrease in revenue that's expected from the course of action compared to the alternative. So if we go back to our slide here, The differential revenue, of course, would be $20,000. That is the difference in revenue between the two alternatives. Alternative one, leaving the seats as they are. Alternative two is installing the saddle bar. So the difference here is 20,000. So 20,000 would be our differential revenue. Then we look at our differential cost. That's the amount of the increase or decrease in cost that is expected from the course of action compared to the alternative. So going back to our example, the difference in cost is $5,000. We can see that in alternative one, 60, alternative two at 65. So the difference of 65 is $5,000. And then, of course, we look at our differential income or loss. And that's the difference between the two revenue within the differential. And so there we're looking at a $15,000 increase in income between the alternatives. The differential income indicates a decision that is expected to increase income. That's, of course, the objective of any differential analysis is to increase income. And so a differential loss would indicate the direction that it's expected to decrease income. So based off of these two alternatives, it would be advised to install the salad bar because we would see a $15,000 increase in potential income. The differential analysis is prepared in 3 columns, where positive amounts indicate the effect is to increase income, and negative amounts, of course, would decrease income. The first column is the revenues, costs, and income for maintaining the floor space in our alternative one. The second column would be revenues, costs, and expenses that would from decreasing the floor space to install the saddle bar. It's alternative two. And the third column is the differences between the two. And so let's look at that here. So this is what it looks like on a report. Alternative one would be leave the tables as they are. We see our revenues at 100,000, our costs are 60, giving us a net income of 40. The installing the saddle bar potential revenues is 120, cost would be 65, leaving us an income of 55. The difference between the two, as I explained before, the revenues would increase by 20,000. Our expenses would increase by 5, leaving us a difference in income of 15. Everyone understands this concept, differential analysis?
Yes.
Great. Yeah, that one's nice and easy. I like differential analysis. So let's looking at our decision. So step 4, making the decision. Based on the differential analysis report that we just saw, the restaurant should decide to replace some of the tables with a salad bar, and doing so will increase their revenue by 15,000. That's, of course, the objective of business, is to increase revenues wherever possible. In step 5, we would review, analyze, and assess the decision. So over time, the restaurant should be looking at their actual revenues and costs compared to the projected revenues and costs based off the slides we just saw. If the actual revenues and costs differ significantly from the data that we gathered in step 3, we should probably run another differential analysis to verify that the correct decision was made. So essentially what this step 5 tells us is that we need to continually evaluate ourselves. We need to keep looking at our decisions incrementally based off the decisions we made in the past. So based off of what we just saw, based off of common decisions, here are some of the common decisions that we would use differential analysis in as managers. The decision between leasing or selling equipment. In your personal lives, you might want to look at this as leasing or selling a car. It's the same type of principles apply in that type of decision making. Discounting an unprofitable segment, manufacturing or purchasing a needed part. Manufacturing or purchasing is a very large decision in business. Replacing a fixed asset, selling a product or processing it further, accepting additional business at a special price. So all of these types of decisions, we would want to use a differential analysis, or basically really what we're saying here is anytime that you're faced with two or more potential options, you should really run a differential analysis to determine which of the two or more would be the best option for you. So let's look at lease or sell. This one's a fun one, in my opinion. Management may lease or sell pieces of equipment that are no longer needed. This may occur when a company changes its manufacturing process and can no longer use the equipment in the manufacturing process. From a service business, a lot of times that we have copiers or printers or fax machines, the relatively large industrial ones. Now, sometimes the business will either purchase that or lease that. And so we oftentimes would want to run a differential analysis to determine whether that's a good decision should be to either purchase or lease. And then also in the sale process, should we lease or sell it? So that's kind of like the analysis that I give, because I had to make that decision myself as a manager of whether to lease or purchase a large copying piece of equipment. They're very expensive. They're like $20,000 for a halfway decent printer, copier, fax that's for industrial use. And so that type of decision, you really need to do a differential analysis to determine if it would be worth it or not. And so in that type of decision, we look at things like the cost of ink, the cost of maintenance, the cost of repairs or service, how much per page it costs in the lease or sell process. And so those type of decisions are really, really important in business. So looking at it here from an example, let's assume on June 22nd, the current year, Marcus, this is your company. It says Marcus Company is considering leasing or disposing of the following equipment. The cost of the equipment was $200,000. The accumulated depreciation on this equipment is $120,000. Giving the book value of $80,000. So there's two options that we're looking at here. The first alternative is to lease the equipment, and the second alternative is to sell it. So looking at the lease, if we lease this equipment, the potential revenues for a 5-year lease would be $160,000. The total estimated repair, insurance, and property tax expense during the life of the lease would be $35,000. And the residual value at the end of year 5 would be 0. So as you probably recall from Accounting 201 or from earlier chapters, we talked about things like residual value. With residual value, essentially what this tells me is that the useful life of this equipment is 5 years. And at the end of that 5 years, the essential value is 0. The book value is going to be 0 because it would have fully depreciated throughout that time. In a lease situation, we don't really look at depreciation as much as we do the associated costs with it. And the reason being is because in a lease, you technically don't own the equipment, so therefore you can't depreciate it. You can only expense it out. And so having said that, in this example, we're looking at potential revenue of $160,000 and estimated expense of $35,000. The other alternative, of course, would be to sell the equipment, sales price of $100,000, and the commission on sales would be 6%. So looking at this information, what do you all think? Would you either would you want to lease or sell this equipment? What do you think?
Sell.
You want to sell it? Why?
I want to sell it because it serves. It's not an asset. It don't serve. It's not no long-term asset.
Okay, that's an interesting perspective. What else?
if you lease it, you can have money every month, to help with your bills and stuff also.
That's true. Yep, and I think it's important to really look at all of these considerations when making the decision. So let's take a look to see what the company decided.
Yeah, I would leave.
Yep. So of course, what you would want to do is run out the differential analysis on it too. So from a lease perspective, we have the revenues. What we said was 160. Our costs we said were 35,000, which would give us an income of 125. If we were to sell it, we said that our revenues would be 100,000. Our commission expense would be 6,000, giving us an income of 94. So looking at this again, would you rather lease or sell?
Lease, because you gaining $60,000 in revenue additional.
That's right. And if you also look at it from the income perspective, the difference between the lease and the sale is 31,000. So I mean, if it were me, I would really want that 31,000.
I would lease.
I would lease, exactly. Yeah, this is a fun example. I like it. So again, so Mark, from your perspective of selling, it's really important that we go through these differential analysis to kind of understand which of the two would generate a better revenue for us, for the company. Does it make sense?
Yeah, absolutely.
Great. Cool. Wonderful. Well, that was fun. I enjoyed that. Thanks for playing along. All right. So finishing up lease or sell. Only the differential revenues and differential costs associated with the lease or sell decision is included in the differential analysis. We did not take into consideration the book value of 80,000. So we said the purchase price was 200,000 minus 120,000 in cost. The equipment is a sunk cost and is not considered in differential analysis. So just like I said before, because it's a piece of equipment that technically is not owned, we don't really take into consideration the fact of the accumulated depreciation. We consider that the accumulated depreciation as a sunk cost. So sunk costs are the costs that have been incurred in the past and cannot be recouped through a relevant or future decision, such as a depreciation. So that 80,000 in this example is not affected regardless of which decision is made. Okay, so let's look at the discontinuation of a segment or a product. So as you know, in the natural environment of business, we discontinue products and services all the time. And the reason being is because they are out of date, they're obsolete, they're no longer relevant, so forth and so on. So a product, department, branch, territory, or other segment of business may be generating a loss at some point. So as a result, the management should consider discontinuing or eliminating the product or segment, especially if it continues to generate a loss. Most companies don't want to have some type of product or service on their books that continually is losing money. That's not the objective of business, right? And so in that case, we would want to look at the possibility of discontinuing or stopping that segment or product. So discontinuing the product or segment usually results in the elimination of the variable costs, such as direct materials, direct labor, and factory overhead associated with that product. However, fixed costs such as depreciation, insurance, and property taxes, of course, those will not be eliminated because, as you know, those costs continue in the business regardless of the products. It's possible for the total company income to decrease rather than to increase from an unprofitable product or segment if it's discontinued. So let's look at the income statement by product. In this example, this is a cereal company. We'll pretend it's General Mills. They make cornflakes, toasted oats, Raisin Bran. And so looking at these products, we can look at their sales, the cost of goods sold, the gross profit, operating expenses, so forth and so on for each product. We can see by just glancing quickly at this report that our Raisin brand is not doing so hot. In fact, it's generating a loss of operations of $11,000. And it looks like we're just not selling a lot based off of the sales figures of 100,000 in comparison to the other products. It looks like it's just kind of no longer a product that is viable for the company, especially if it's continuing to lose $11,000 on an annual basis. And so, having said that, and we can see that it's negatively impacting the bottom line of the company, right? The income from operations for the whole company. And so the company may want to consider discontinuing the Raisin brand, especially since there's a loss. So let's look at the differential analysis between continuing or discontinuing the Raisin brand. So if we continue, we'll continue to earn $100,000 in annual revenues. Our variable, fixed, and total costs would remain the same, and our loss will continue to be $11,000. Now, here's an interesting point. If we discontinue the Raisin brand, of course, our revenues will drop to zero because we won't be making revenue from something that we've discontinued. Our variable costs will go to zero because we're no longer manufacturing the product. Our fixed costs will remain the same. And the reason being is because I'm still going to have the property, plant, and equipment. And I'm still going to have to pay my insurance for the building. I'm still going to have the building, all that stuff. So my $26,000 will still be there. And so if I discontinue, my loss will be $26,000. So the question then becomes, do I want to discontinue it or not? If I continue it, my losses are $11,000. If I discontinue, my losses are $26,000. The difference here is a loss of 15. So what do we do is the question, right? So what would you do? That's a good question. What do you think? Would you discontinue it or not?
Yeah, I would definitely discontinue it because it's no longer making no profit. So I will definitely discontinue it, or I'll try to get another method that could generate profit.
Yeah, I agree with that. I mean, I would probably continue it for now because if you look at the losses, right? If I continue it for now, I'm minimizing my losses until I'm able to replace that product with something else that would be profitable. At that point, I would probably change it out.
Okay.
Yeah, I agree with you though. That makes sense. It's a good decision. Okay, so now let's look at the make or buy decision. This one's also very interesting. So in this example, or in this process, we're looking at whether a manufacturing company would be better off making or buying product for sale. So companies that manufacture products made up of components rather than assembled into a final product like an automobile, the decision must be made whether to make the part or purchase it from a supplier. So think about we talked about Tesla in the past. We talked about General Motors as an example. We talked about Ford. So let's take one of those. We'll say it's Ford, okay? And let's say Ford is trying to make a decision whether to purchase the transmissions for their cars from a supplier directly, or do they want to manufacture the transmissions for themselves? so that is a difficult decision because of the various expenses associated. So let's look at whether we should do what we should do. So let's assume that Ford is manufacturing, purchasing instrument panels for their transmission for $240 a unit. The factory currently operates at an 80% capacity, and no major increase in production is expected in the near future. The cost per unit of manufacturing an instrument would be estimated with the following. So direct materials would be $80. Direct labor would be another $80. Variable factory overhead will be $52. The fixed factory overhead will be $68, which would give us a total cost per unit if we manufactured it in-house of $280. So my question to you all is, would you make it in-house or purchase it? What do you think?
Purchase.
Yeah, purchase.
Okay, so why? Why purchase?
Because if you purchase it, it'll be 240, and if you make it in-house, it's 280.
That's right. So if you do a differential analysis on this, we're looking at a difference of $40 in the cost per unit. So you're right. I would also purchase it because we are saving $40 per unit if we purchase. Very good. Okay, so this is kind of breaks it out even further, because now we have more information. So let's look. So if we purchase it, it's $240. If we make it, it's $280. But here's the difference. And this example really didn't. It did highlight this a little bit. The thing we did not consider in our decision is the fixed factory overhead. So the thing is, and now in looking at this, it's different, right? Because the fixed factory overhead exists regardless of whether we make it or buy it. So just like we talked about in an earlier slide, we had said that the fixed factory overhead exists regardless of either decision, because we still have to pay rent, we still have to pay the utilities, the insurance, all of that, regardless of whether we make or buy it. Because even if we buy it, we still have to store it in our facility, right? So now looking at the difference, which one would be better?
To make it.
To make it, yeah.
Oh, making it.
Yeah, absolutely. Because my expense in making it would be $280 versus $308, giving us a difference of $28 per unit. So everyone kind of understands this concept?
Yes.
Yeah, great. Yeah, that was an interesting one. Okay, so now let's looking at replacing an equipment. So I gave you all an example of this from my personal experience in class a few weeks ago. I had talked about when I was a financial controller at Radisson Hotels, we had a situation where our chiller broke, and we had to make the decision of whether to repair or replace the equipment, right? And so this is kind of an interesting concept, because that decision in itself can be somewhat challenging. So the usefulness of a fixed asset may decrease before it's worn out. So for example, old equipment like a chiller may no longer be as efficient as new equipment. And eventually it'll probably break, by the way. Differential analysis can be used in making the decision to replace fixed assets such as equipment and machinery. The analysis normally focuses on the cost of continuing to use the old equipment versus replacing it. The book value of old equipment is a sunk cost, and it thus is irrelevant. So it's kind of like saying, it's already fully depreciated. There's so the rest of that cost is all sunk, right? And so let's look at this example. Pretend this is my chiller, only just add a couple zeros on it. So assume that the company is considering replacing a chiller with a new one. So the old one, it's worth $100,000. The estimated variable manufacturing cost is $225,000. Estimated selling price will be $25,000, and its remaining useful life is 5 years. It's because we keep making band-aids on it, right? If we want to purchase a new one, it's $250,000. The estimated annual variable manufacturing cost is $150,000. Residual value at the end of the 5 years would be 0, and its useful life will be 5 years. So, yeah, that's interesting. So if we compare the two, the book value, if we purchase it, would be $250,000 instead of $100,000. The estimated variable manufacturing cost would be decreased if we purchase a new one by $75,000. So let's see. Let's take a look. It's an interesting decision. Okay, so if we continue with the old machine, obviously we wouldn't sell it because we're going to keep using it. The variable manufacturing cost would be minus $1.125 million for the 5 years, because this is annual, yeah? Estimated annual variable cost of $225. So estimated annual at $225 times 5 is $1.125 million, which means that over that 5 years of the useful life, I would be out $1.125 million. If I replace it, I can sell the old one for $25,000. My purchase price will be $250,000. Variable manufacturing will be $750,000. Because again, you're looking at your $150 times 5, so $750,000 to get your total cost of $1 million. So you take your revenue minus your total cost to get to $975,000. You'd be out. So, I mean, it's clear to me that I would want to replace that old machine based off of this difference. What do you all think? Does that make sense?
Yes, sir.
You say to replace it, right?
Yeah, absolutely. Does that make sense?
Which part is the revenue? The $750,000?
No, so there's no revenue, right? So, because we're just looking at purchasing a new machine, and we're going to replace the old one, but we're going to sell the old one for $25,000. So $25,000 will be the revenue that we would get from selling the old machine.
Right.
The $250,000 is the purchase price, and then of course we have maintenance costs or manufacturing costs associated with it.
Right.
And so that would be an additional cost of $750,000. So my total cost would be $1 million. So I would take my revenue of $25,000, subtract out $1 million to get minus $975 in total loss. So I would rather lose $975 instead of losing $1.125.
Right. So in any differential analysis, we want to always subtract the revenue from the total cost.
Absolutely. Absolutely. Yep. Yep. Very good. So yeah, so given this analysis, it totally makes sense to go with replacing the machine.
So what do the differential effect on income do? So that's just calculating how much it would make it.
Yeah, so Mark, the whole concept behind a differential analysis is to look at the difference between two decisions. So decision one was we keep the old machine running. Decision two is we replace the old machine with a new one. And so what I do is I take the difference of each decision to perform my differential analysis. So 0 minus 25 is 25.
Right.
and so forth and so on, right? So that's the whole concept. And if it shows that our difference is basically positive or makes sense that our net is either less than the other alternative, then we go with that decision.
Gotcha.
Awesome. Cool. It's a good concept. So the revenue that is foregone with the alternative in any decision that you make, the revenue that is foregone, and we talked about this, I want to say in like chapter 16. I think it's the first time you probably heard this. The revenue that's foregone from an alternative of the use of assets such as cash is called an opportunity cost. So anything that is foregone is called an opportunity cost. So although the opportunity cost is not recorded in accounting records, it's good to understand it for analyzing alternative courses of action. So processor sell. So in this decision, we want to figure out whether it makes sense to continue to manufacture a product or to sell it as it is. When we say continually manufacture it, that means to make edits or make improvements to the product in order to earn a higher sales dollar. So it's kind of like the difference between selling it as it is or modifying it to sell it as an aftermarket type product. So during the manufacturing process, a product normally progresses through various stages of the process. In some cases, a product can be sold at intermediate stages of production, or it can be further processed and then sold. An example of this would be like a car. You know how if we gave this example a couple chapters ago where I think it was like Tesla or something like that. So you can buy the base model Tesla, right? Or you can buy the next model up. It's got all the bells and whistles. It's got the additional safety features. It's got the nice leather to it. It's got all those types of features. So essentially, what we're looking at here is: do we want to just sell the base model Tesla, or do we want to sell the level up, right? So differential analysis can be used in this decision to describe whether to sell the product at an intermediate stage or to further process it. And so in doing so, the differential revenues and costs from further processing it are compared. The costs of producing the intermediate product do not change, regardless of whether the intermediate product is sold or processed further. So here's an example. Kerosene. Oh, yeah, this is interesting. So kerosene, for those of you who don't know what it is, it's a fuel. It's a type of fuel typically used in heating. And so kerosene is a fuel. Think of it like oil. Or gasoline. It's very similar in respect to process. And so with kerosene, it is manufactured in batches or gallons. So the batch size in this example is 44,000 gallons. The cost of producing kerosene is $12,400 per batch. The selling price is $2.50 per gallon. Kerosene can be processed further to yield gasoline in the following. Input batch size will be 4,000 gallons minus evaporation. That evaporation is essentially the loss of gallons through the evaporation process of the vapors escaping into the atmosphere. The output batch will be 3,200 gallons. The cost of producing the cost of producing the gasoline will be $3,050 per batch, and the selling price of $3.50. So we look at it from this perspective. Option one is to sell kerosene. Option two is to convert it into gasoline. So from a kerosene perspective, our revenues would be $10,000. Our cost would be $2,400 to get us net income of 7,600. If we process it further into gasoline, revenues will be 12,200. Our cost will be $3,050 to get us to a net income of 8,150. That gives us, of course, a differential net of 550. So in this example, it would make sense for me to further process the kerosene and make it into gasoline because, of course, it would yield me additional revenue, which, again, is the objective behind differential analysis. Okay, so here's another component differential analysis, looking at to accept business at special price. So a company may be offered the opportunity to sell its products at prices other than its normal prices. This is kind of like offering discount pricing or special pricing for contracts, that type of thing. So, for example, an exporter may offer to sell the company's products overseas at a special discount price. Differential analysis can be used to decide whether to accept the business at a special price. In other words, does it make sense for the company to offer discounts on its products? And we could use differential analysis to make that decision. The differential revenue from accepting the additional business is compared to the differential costs of producing and delivering the product to the customer. Differential cost accepting different depends on whether the company is operating at less than its capacity. So in other words, I need to have that capacity in order to generate the additional product to be sold at a discounted price. If the company is operating at less than full capacity, then of course the additional product does not increase the fixed manufacturing costs. So just like before, the fixed costs remain the same regardless of how much is being sold. So let's go ahead and take a look. So let's assume B-Ball, that's a great name. Let's assume that B-Ball company makes basketballs. I mean, what better name for a basketball company, right? So let's assume the company makes a monthly capacity of 12,500 basketballs. Current monthly sales of basketballs is 10,000 per month. That's good. The normal selling price per basketball is $30. I mean, that must be a pretty nice basketball. It must be like a Wilson or something. So let's look at the manufacturing cost for a basketball. The variable costs are $12.50. As you know, variable costs include the materials, direct labor, factory overhead. Yes. And of course, there's fixed costs, which are things like insurance, the other fixed overhead components, right? So, and that gives us to a total manufacturer price of $20 per basketball. That's not bad. That means I'm getting $10 in profit per basketball at the domestic price. Now, on March 10th, the B-Ball company received an offer to export 5,000 basketballs at $18 each. Production can be spread over 3 months without interfering with normal production and incurring overtime costs. Pricing policies in the domestic market will not be affected. So that's an interesting proposition. So let's take a look at this. So if I reject the alternative of selling the additional basketballs overseas, well, I'm not going to get any additional revenue if I decline this offer. If I accept the offer, if I sell 5,000 basketballs at $18 each, I'll be able to yield $90,000 in additional revenue. My costs of manufacturing the basketballs at $12.50 for the 5,000 basketballs to be sold overseas would be $62,500.
Excuse me, Professor. How come fixed costs are not included in this example? Fixed costs.
Why are fixed costs not included? Because the great question, Marcus. I appreciate you asking that. So looking back at this slide here, the reason why fixed costs would not be included in this additional production line is because the fixed costs are already being incurred by the local market. So in other words, the fixed costs exist regardless of where the basketballs are being sold. They are being incurred at the local level. So in other words, this would just be kind of like in addition to what I'm already doing. Does that make sense, Marcus? Yes, hopefully. I'm sorry, Marcus, I can't hear you, buddy.
Makes sense.
Okay, great. So again, Marcus, just kind of think of it like an additional product line, but the fixed cost is being included for everything domestic.
Okay, I got you.
Great, awesome, thank you, sir. And so we can see here that the alternative, if we do sell these basketballs overseas, would yield us an additional $27,500 in net income. So it would make sense for the company to do this deal. It makes sense to me. So the special business is accepted even though the sales price is less than the manufacturing cost of $20 per unit, because again, the fixed costs are not affected by the decision and thus are omitted from the analysis. Very good question. So what should we do about selling price? So we need to set normal selling product pricing. So normal selling product pricing is the target sales price that we want to achieve in the long term. The normal selling price must be set high enough to cover all of its costs and expenses. That's both fixed and variable. That makes sense to me. You know, you want to be able to cover your both fixed and variable costs at any time that you're selling anything, right? And so we want to be able to provide a reasonable profit. So again, anytime you're setting your sales price, you have to make sure that you're covering your fixed and variable expenses, and you want to make sure that it's high enough to the point where you're making a reasonable profit. So managers can use one of two market methods to determine its sales price. We did talk about this, I believe, in an earlier chapter to some degree. So a demand-based concept or a competition-based concept. In the demand-based concept, we're setting our sales price based on the demand for the product. If there's high enough demand for the product, then we can set the sales price higher. Likewise, if there's lower demand for the product, we can lower our prices. In competition-based pricing, it works a little bit differently. So competition-based pricing, we set our prices according to what our competitors are selling the same or similar product for. An example of this would be the reduced price that management adjusts it to meet the competition. So here's an example I like to use is for the airlines. So for those of you who have traveled on an airplane, or if you regularly travel, you might look at airline ticket pricing. And airline ticket prices are set by either demand or competition based. So for example, let's say Delta Airlines sets a ticket round trip from DC to Orlando for 120 bucks. You might also see that American Airlines will also put their ticket price at $120 because they want to compete directly with Delta. So that would be the competition-based concept. And then if you look at demand, let's say it's spring break and everyone wants to go to Orlando to go to the theme parks, then the price per ticket from DC to Orlando would increase based off of that demand being high during the spring break time. And then, of course, the price will go down for round trip ticket from DC to Orlando during the summer months because demand is much lower for Florida in the summer months because of how hot it gets. So those are just some examples of demand-based and competition-based pricing. So managers can also use one of three cost-plus methods to determine the selling price. There's product cost concept, total cost concept, and variable cost concept. So let's look at cost-plus first. Cost-plus methods determine the normal selling price by estimating the cost amount per unit and then adding a markup. So what we do is we take the cost per unit and we add additional markup in. Now, markup is usually set by management because they want to set the desired amount of profit that they want to earn per product. So the markup should be sufficient to earn the desired amount of profit and to obviously cover all of its costs and expenses that are related to the manufacturing of that product. So again, cost plus, all we're doing here is we're taking the cost of the product and then adding in additional markup or adding in the profit that we want to see for that product. In the product cost concept, the only cost of manufacturing the product are termed product costs. And so these include the cost of the amount per unit to which the markup is added. We estimate the selling expenses, administrative expenses, and desired profit, and we include those items in the markup price. The markup per unit is then computed and added to the product cost to determine the normal selling price. So essentially what this tells me is I take my manufactured price, that's my direct materials, direct labor, factory overhead, that makes up my total cost per unit. I then add in my estimated selling expenses, administrative expenses, and desired profit. So that part makes up the markup, and I add those two together to get my normal selling price. The product cost concept is applied using the steps listed in the next slides. So step one, of course, you gather your data: direct material price, direct labor price, direct factory overhead price. You get all those costs together to get your total product cost. Next thing you do is you estimate your selling administrative expenses. And then we're going to divide the total product cost by the number of units expected to be produced and sold to determine the product's cost per unit. So total product cost divided by estimated units produced and sold. And then what we do is we again add in our desired profit to our total selling administrative expenses, divide that by our total product cost to get our markup percentage. And then what we do is we take our desired rate of return, multiply that, which we learned about in the previous chapter, multiply that by our total assets to get our desired profit. And then we take our markup percentage, multiply that by our product cost per unit. And then we determine what the normal selling price is by taking our product cost per unit and add that to our markup per unit to get our normal selling price per unit. So let's look at an example. So this company, I guess, is making calculators. 100,000 calculators would it be expected to produce and sell during the current year. So I'm going to make 100,000 calculators. My direct materials is $3 per calculator. That's 300,000 total. My direct labor, it's cost me $10 per calculator to make. for direct labor. So that's $1 million. My factory overhead is $200,000. Remember that part's relatively fixed. My total manufacturing costs are $1.5 million. I got that by taking my direct materials plus my direct labor plus my factory overhead to get my total manufacturing cost $1.5 million. I estimated my selling and administrative expenses to be $170,000, giving me a total cost of $1.670 million to get to a total asset of $800,000. And so I take my total assets, $800,000, and my IRR, or desired rate of return, 20%. So now I determine what the normal selling price should be. I said that my total product costs were $1.5 million. My estimated selling and administrative expenses of $170,000. My total cost per unit would be $15. I got the $15 by taking my total product cost of $1.5 million. I divided that by the 100,000 units I expected to be produced and sold to get to $15 total cost per unit. Then I figure out my markup percentage. I got that to be 22%. The way I figured that out is I took my IRR, or desired rate of return, 20%, multiply that by the 800,000 to get the 160. I then took my desired profit, added that to my total selling administrative expenses, and divided my total product cost. So I took 160,000 desired profit plus 170,000 estimated selling administrative expense divided by total product cost, 1.5 million, to get to 22%. Of course, remember, order of operations. There really should be parentheses on this top part. So you want to make sure that you do your profit plus your selling administrative expenses first before you do the division. And then, so my market percentage will be 22%. I then need to figure out my markup per unit. I take my markup percentage, which is 22%. I multiply that by my product cost per unit, which is $15, to get $3.30 per unit, which is my markup per unit. And then to get my normal selling price, I would take my total product cost per unit, $15, plus my markup per unit, $3.30. My normal selling price per unit should be $18.30 per unit. Any questions on product cost?
No, I understand.
Great. So as you can see, as long as you follow these steps, you'll be able to derive the correct responses for figuring out the normal selling price. It's all about the steps. As long as you do the steps in order, you'll be fine. Okay, so let's talk about target costing quickly. So target costing is a method of setting the prices to assume that it combines market-based with cost reduction. Under target costing, a future selling price is anticipated using the demand-based or the competition-based methods. The target cost is then determined by subtracting a desired profit from the expected selling price. So again, target cost would be expected selling price minus the desired profit. That would get us our target cost. Target costing tries to reduce the overall cost. Target cost is normally less than its current cost. Makes sense, because the objective here is to reduce total cost. Managers must try to reduce costs from the design and manufacturing process of the product. The planned cost reduction is sometimes referred to the cost drift. Cost can be reduced by simplifying the design, reducing the cost of direct materials, reducing direct labor costs, and eliminating waste. We talked about this concept before. I want to say it was like 2 chapters ago. Production bottlenecks. These are such a pain. Okay, so production bottlenecks. This is a constraint point where the manufacturing process, where the demand for the company's products exceeds the abilities to produce the product. An example of this would be like toilet paper right now. It's where the manufacturing is having a difficult time keeping up with the demand, and so it's causing what we call production bottlenecks. It's where the demand really is exceeding the point where the company's ability to produce the product. So, and so in this, we take into consideration the theory of constraints, which is the manufacturing strategy that focuses on reducing the influence of bottlenecks on the production process. When a company has a production bottleneck in its production process, it should attempt to maximize its profits subject to the production bottleneck. In doing so, the unit contribution margin of each product per production bottleneck constraint is used. So let's look at this from an example. So let's assume that this company makes 3 types of wrenches: small, medium, and large wrenches. A wrench, as you know, is a tool that we use to fix stuff. So all 3 products are processed through a heat treatment operation, which hardens the steel tools. That's basically the concept of how we form tools, right? Is through heat. So this company, heat treatment process, is operating at full capacity and a production bottleneck. It has a production bottleneck because it's operating at full capacity, and that means its demand is very high. The product unit contribution margin is for a number of hours of heat treatment is the following. So the selling price for the small wrench is $130, medium is $140, large is $160. The variable cost per unit is the same, $40 per unit. The unit contribution margin is $90, $100, and $120 respectively. And of course, the larger the wrench is, means the more product that it more materials it has, which also means the longer it takes to form or to heat treatment each product, or each different product. For small, it's an hour. For medium, it's 4. And for large, it's 8. So what we need to do is we need to figure out the unit contribution margin per production bottleneck hour. So in a production bottleneck operation, it's best to measure the profitability of each unit contribution per period during the bottleneck constraint. So for this company, the production bottleneck constraint is the heat treatment process hours. Of course, as you would anticipate, the longer it takes to manufacture a product, the greater the constraint is. So therefore, the unit contribution margin per bottleneck is expressed by the following. We take the unit contribution margin and divide that by the heat treatment hours in this example. So for a small wrench, the unit contribution margin is $90 per hour. The medium wrench would be $25, and the large wrench would be $15. Again, what we do is we take the unit contribution margin and we divide that by the amount of time in the manufacturing process, so the heat hours in this example. So the small wrench, well, of course, in this example, would actually yield the greatest return, right? The greatest contribution margin. So let's look at real quick. We'll jam through the appendix. Only the important slides we have here. So under the total cost concept, manufacturing cost plus and the selling administrative expenses are included in the total cost per unit. The markup per unit is then computed and added to the total cost per unit to determine the normal selling price. These are just, I'm just highlighting the concepts that we talked about earlier that are a little bit important to discuss. To figure total cost concept, you take, you follow the steps just like we discussed earlier. First thing you do is you gather your data, direct materials, direct labor, factory overhead, which is your total manufacturing cost. Second thing you do is you estimate the total selling administrative expenses. Then you estimate the total cost by taking your total manufacturing cost and adding that to your total selling administrative expenses to get your total cost. And then, of course, step 4 will be to take your total cost and divide that by your estimated units produced and sold. Step 5 would then be take your desired profit, divide that by your total cost to get your markup percentage. And then we would also want to figure out the return on the assets. So you look at your desired rate of return, multiply that by your total assets to get your desired profit. Then we take our markup percentage, multiply that by our total cost per unit to get a markup per unit. And of course, the last step would be to take your total cost per unit, add in the markup per unit to get your normal selling price per unit. And then, of course, looking back at our example, we have the data that was given to us, like we discussed earlier. And just like the example that we used earlier, we go through the steps. And this is basically capturing the earlier slides, kind of showing each step in the process to get to a normal selling price. And then looking at the variable cost concept again, we want to look at it from a variable manufacturing cost perspective, including the selling administrative expenses, fixed manufacturing costs, fixed selling and administrative expenses, and the desired output should be included in the markup price. Markup price per unit is then added to the variable cost per unit to determine the normal selling price. So it's slightly different than the fixed approach, as you would imagine, like we discussed earlier. Again, you do the same process. You take to get your total variable cost per product. You get your direct materials, direct labor, and your variable factory overhead, not the total factory overhead, but the variable factory overhead. Because again, we're looking at the variable cost concept. You estimate your total variable selling and administrative expenses. To determine the total variable cost, we take our variable product cost plus our variable selling administrative expenses to get the total variable cost. We then take our total variable cost, divide that by the estimated units that we are going to produce. To get the markup percentage, it's the same concept. From before, we take our desired profit, add that to our total fixed cost and expenses, divide that together by our total variable cost. Again, order of operations, make sure you do the numerator first, or the numerator first. The desired profits are only computed by taking the desired rate of return times the total assets, just like you've done before. Then we take our markup percentage, multiply that by our variable cost per unit. And then, of course, to get our normal selling price, we take our variable cost per unit, add in our markup per unit to get our normal selling price. Okay. And this is more of the same. And of course, these slides are all on the module. So that was chapter 24. So your question is, what's next? So on Thursday, you will have an exam. So there will not be a virtual session on Thursday. I will open up the exam for a 24-hour period, just like before. The exam will cover chapters 22, 23, and 24. It will be 50 questions, a mix of true, false, multiple choice, and a few matching. I will limit the amount of math questions, just like I did for the midterm. So you'll have a full 24 hours to complete the exam, just as before. And so that exam will take place on Thursday, which will be April 2nd. If you have any comments, questions, or concerns, I'm always available by email. Of course, you can always get a hold of me that way. It's really the most effective way, as most of you know. Are there any comments, questions, or concerns on Chapter 24 or on the upcoming exam?
No, not at this time. But I would like to know when is our final exam.
The final exam, I need to look at the exam calendar once again. Because the vast majority of the students in this class are graduating from the associate's program, the exam will take place during that final exam week for graduating seniors, which I believe is the 20th through the 24th. I would project that the exam, final exam, would probably take place on April 21st.
Okay.
Does that make sense? Yep.
So Professor, with that being said, so if we're doing the exam, so actually our class will be over on the 24th or the 21st?
Yeah, so the way it'll work is our last session that we'll have our last WebEx session will take place on April 16th, and then you'll have your final exam on April 21st.
Okay, so our class with you will be over.
On April 16th, that's correct.
Okay. Is that for all the classes in the school?
That's for the ones that are at the level where most of the students are graduating.
Well, I got most of the students graduating in all my class.
Yeah. So I would assume that to be the case. Yep.
Okay. Thank you so much for letting me know.
Absolutely. So again, are there any other comments, questions, or concerns?
Nope.
Professor, what time are you going to open up the exam on Thursday?
Yeah, Thursday at midnight it'll be open, then it'll close at 11:59, same day,
Okay.
just as before.
All right.
Right.
So Professor, also, you said you were going to put no math questions up there?
I'm going to limit it. I can't promise you that there won't be any, but it'll be very limited.
Oh, okay.
Good question. Great. Well, if there are no other comments, questions, or concerns, I'm going to conclude this recording.